Good afternoon, and welcome to the 20th EBI policy series. I'm your host, Nejc, Smole, and today we will focus on the ECB's banking supervision, the SSM supervisory priorities 2023 to 2025. The ECB banking supervision has reviewed its strategic priorities for the next 3 years, in close collaboration with the national competent authorities, and the review builds on a thorough assessment of the main risks and vulnerabilities for supervised banks in a very challenging environment. The SSM supervisory priorities build also on the outcome of the 2022 supervisory and evaluation process, the SREP. Now, before I introduce today's speakers, who will shed some more light on this topic, please let me quickly provide you with the format of our webinar. The webinar is planned for an hour. Keynote speaker and co-discussants shall present their views for the first half of the hour. That should leave us with sufficient time for the Q&A discussion. In this part, the audience is also welcome to pose a question in the Q&A tool, and if they fit, I will include them in the discussion. Now, we're very grateful to have with us Mr. Gstädtner as the keynote speaker, and as co-discussants, Mr. Peter Simon and Professor Christos Gortsos. Please let me quickly introduce the panel in greater detail. Gstädtner is head of division at the European Central Bank and president of the Supervisory Board of the EBI. Thomas has been working at the ECB since May 2014 as head of division in the DG SIB. His department is responsible for supervising 3 globally significant institutions within the Eurozone. In addition, Thomas is also head of the country coordination team for the French banks under the ECB supervision. Before ECB, Thomas worked for Deutsche Bank in London in different managerial positions, his last position being head of legal regulatory change management. Prior to that, he was general counsel in an asset management company and an associate in a law firm in Munich. Also, Thomas is a qualified lawyer in Germany and solicitor in England and Wales. He is also president of the European Banking Institute's Supervisory Board. As first co-discussant, I would like to introduce in greater detail Mr. Peter Simon, who is managing director of the World Savings Banking Institute, as well as the European Savings and Retail Banking Group. Peter was also a member of the European Parliament for the Social Democratic Party of Germany from 2009 to 2019, where he was also deputy chairman of the Committee on Economic and Monetary Affairs. In 2021, Peter was awarded with the German Federal Cross of Merit for his work in the European Parliament. Peter holds a law degree from Ruprecht Karls Universität in Heidelberg and has written various publications on EU law. Our second co-discussant is Professor Christos Gortsos. He is a professor of public economic law at the Law School of the National and Kapodistrian University of Athens and currently a visiting scholar at the Faculty of Law of the University of Zurich. He's specializing in financial regulation and central banking law. Christos is also the president of the academic board of the EBI. Christos studied law, economics, finance, as well as international history and politics at the NKUA and the Universities of Zurich, Pennsylvania, and Geneva. Now, a warm welcome to our panelists once again, and without further ado, I would like to give the floor to Thomas for his keynote address on this topic. Thank you very much.
And thanks so much, Nejc, also for a kind introduction, and also welcome from my side, also to the co-discussants. So today is about the ECB supervisory priorities for the next 3 years. And a short introduction, I would like to turn a spotlight on some of the key elements of our revised strategy. The regular revision of our priorities builds on the updated assessment of the main risks and vulnerabilities of the euro area banking sector, the progress made on the priorities endorsed in the last years, and the outcome of our annual supervisory review and evaluation process, the SREP. The ongoing Russian aggression against Ukraine and its adverse economic and financial impact have led to high uncertainty that calls for extreme prudence and the need for both banks and supervisors to swiftly adapt to a rapid changing environment. When reviewing the medium-term strategy of ECB banking supervision, we tried to strike a balance between two overarching objectives. First of all, on the one hand, making the necessary effort to strengthen the resilience of the banking sector to immediate macro-financial and geopolitical shocks, which should be the main priority in the near term. And on the other hand, ensuring that supervised institutions stay focused on addressing the structural vulnerabilities that were identified last year, because these remain highly relevant in the current context. In the reminder of these opening remarks, I would like to first describe a little bit the situation of supervised institutions at this stage and turn to some of the key risks banks are facing, along with the main vulnerabilities and the implications for our supervisory priorities going forward. Okay, so first of all, as I said, an overview about the current status of the banking system in the Eurozone. We're starting with this current situation. The banks have a very good capital level, we have to say. Yeah, so the capital and the liquidity situation is very good, despite a deteriorated growth outlook in the Eurozone because of the changed macro environment. You see this on the graph on the left-hand side. Downside risk obviously include the war that has quite a heavy impact on the economy in the Eurozone, the escalation of geopolitical tensions and the rising energy costs, and obviously a big change for the banking system is the rise of the inflation in the last months in the year. The average CET1 ratio is at around about 15% at the moment, which is very good if you compare it to the last years. In particular, if you compare it to the, let's say, the global financial crisis, this is a number by far higher. Now moving to the profitability of the Euro area banking system. So also profitability has continued to improve in the first half year, and this trend has continued in Q3 and Q4. This is due to the main reason, obviously, is the rising interest rate environment where banks are profiting quite a lot now. The economic rebound following the COVID-19 crisis. I mean, obviously now this has now ebbed down a little bit because of the Russian crisis and the war in the Ukraine. Nevertheless, banks have been able to release provisions which they have been putting back because of the COVID crisis, and this also increased their profitability in 2022. The aggregate ROE was at 7.6% in June 2022. It was more or less the same number, or around about the same number for the full year. But this is to put the whole thing into context, the best number for profitability of the Euro area banking system since the SSM started its work in 2014. So in this sense, also a very good outlook so far. Here on this slide, you see a little bit, let's say, the impact on the net interest income because of the rising interest rates. So it's a sample of 105 significant institutions, and you see net interest income has been increasing quite a lot. Obviously expenses also, but the net interest margin, which is basically the net number, for the banking system has also increased. So it's one of the reasons, as I mentioned before, for the rising profitability of the banking system. On this slide, you see indicators in relation to liquidity. So LCR ratio at around about 160%, net stable funding ratio at 127%. These numbers obviously have to be taken with a bit of caution because the banking system has profited a lot from the very cheap liquidity in the last years. One point to mention is obviously the TLTROs and the expectation of a lower for longer environment. This has now changed. TLTROs have to be repaid by the end of 2024. This will obviously also have an impact on the liquidity of the banking system, and you will hear about this in a bit more detail when we come to our priorities. Last point is then NPL ratios and the outlook in this regard. So you see a very strongly declining trend when it comes to NPLs in the Eurozone. So this has increased quite a lot on a quantitative basis. Here also, when you look into the different countries, you see that the numbers have been decreasing quite a lot. So this is also a very positive development since the SSM started its work, and obviously puts the whole banking system in a much better perspective now when they're facing new crises. A little bit of an outlook here is the question related to stage 2 and stage 3 loans. So they have increased, in particular also stage 2 loans. And then also when you look into particular sectors, you see an increase, and that's why caution is definitely necessary when it comes to this. Now, moving to the supervisory priorities of the ECB for 2023 to 2025, we have prepared a slide here and then following some more details in the slides afterwards. We have divided this into various elements. So credit risk, funding risk, business model, operational risk, governance, and then climate-related issues. Yeah. So this is an overview, and then in more detail, you see here a breakdown of the various priorities that we have set ourselves. First of all, strengthening the resilience of the immediate macro, financial, and geopolitical shocks. So we have, I've described before that the banks have improved quite a lot when it comes to the quantitative number of NPLs in the Eurozone. So at the start of the SSM, we had around about 1 billion of NPLs in the banking system in the Eurozone. This has now moved down to around about 350 billion, so a significant decrease. And now we have decided in the last years already, but now to continue in this regard, that we would like to address also the shortcomings when it comes to the credit risk management, including specifically exposures to the vulnerable sectors in this particular crisis. So the banks should effectively remedy structural deficiencies in their credit risk management cycle, from loan origination to risk mitigation and monitoring, address in a timely manner any deviations from regulatory requirements and supervisory expectations. Our next topic is then a lack of diversification in funding sources and deficiencies in funding plans. I mentioned before and already that obviously money was extremely cheap in the last years. This has changed now due to the inflation and the rising interest rate environment. And that obviously will also cause some challenges for the banking system as a whole, and some obviously more specific also for some individual banks. And this is a point that we have set ourselves also as a priority, that banks reporting high concentration of funding sources, in particular less stable ones, should diversify their funding structure by developing and executing sound and credible multi-year funding plans, taking into account challenges stemming from changing funding conditions. So in the end, also less rely on public funding sources by central banks, and now making themselves prepared that they can also tap again more and to a largest extent, obviously, private funding sources. Next topic is then deficiencies in digital transformation strategies. So a point which is more tackling structural issues in the banking system, also in connection with previous strategies in relation to business model analysis. So obviously digital transformation strategy is a topic which is strongly linked to this. So banks should develop and execute sound digitalization transformation plans through adequate arrangements in order to strengthen their business models, sustainable, and mitigate risks related to the use of innovative technologies. So obviously, more on the higher level of digitalization is also causing a greater exposure to IT and cyber risks. So that's also a point where we are putting an emphasis on deficiencies in operational resilience frameworks, namely IT outsourcing, IT cyber, and IT security and cyber risks. So banks should also have robust outsourcing risk arrangements, as well as IT and cyber resilience frameworks. So that's a point which kind of goes hand in hand also with the increased use of digital transformation strategies. And here, another point also linked to this, it's more related to governance structures, so deficiencies in management body functioning and steering capabilities. So banks should effectively address material deficiencies in the functioning, oversight, and composition of their management bodies by developing swiftly implementing sound remedial action plans, adhering to supervisory expectation. Then the next one is also a very important point in connection with BCPS 239. So deficiencies we have detected in the last years and put another emphasis on right now is risks, deficiencies in risk data aggregation and reporting. So banks obviously rely on having adequate and timely data access in order to know what's happening within the organization. And banks should effectively now address long-lasting deficiencies and have adequate and efficient risk data aggregation and reporting frameworks in place. So that's a point we also are pushing the banks very hard to remedy the current situation. And the last point, which is a very new topic on the agenda of supervision and obviously also for banks, which is material exposures to physical and transition risks. So the topic is here climate change and the effect this will have on the real economy and as a consequence also on the banking system. The ECB has been doing quite a lot, and maybe we can talk about this point also in more detail in the Q&A session. But we have set our expectations in this regard, and banks should adequately incorporate climate-related environmental risks within their business strategy and their governance and risk management frameworks in order to mitigate and disclose such risks, aligning their practices with current regulatory requirements, in particular also with the ECB supervisory expectations. So with this short overview, I would like to stop at this stage, and then Nejc, I would hand back to you. Thanks very much.
Thank you very much, Thomas, for this very thorough presentation. I would also like to now hand over to Peter for his views. Peter, the floor is yours.
Thank you, dear Mr. Smole, dear colleagues on the panel, and thank you very much for your introduction, for the opportunity to speak at today's EBI policy series on the topic of banking supervision. ESBG members, just that you get an idea, represent in Europe about 900 saving and retail banks with 163 million EU consumers, and on the worldwide level, 1.6 billion clients. We have very small Italian banks with 15 staff members up to banks in China with 600 million clients. So we are very heterogeneous. Next to the regional and retail-oriented business model of our members, just that you get an idea, they are all committed to be the responsible bankers, not driven by pure profit maximization, but aiming to serve and provide a return to society. But having said this, let's move on to the topic of today's event. The SSM is often and rightfully cited as a success story by many observers since it became operational in 2014. At ESBG, we would also tend to agree with this observation, and as the single supervision of the most significant banks in the euro area has certainly contributed to reinforcing financial stability throughout the eurozone. By establishing a common approach to day-to-day supervision, the SSM positively participated in ensuring a consistent application of regulations and supervisory policies in our view. The SSM strategic planning system over 3 years periods is another positive development that should be mentioned. It allows banks to have more visibility on the ECB activities and to prepare themselves accordingly. Still, not everything is perfect, and I appreciate the opportunity to be in this panel today also to provide feedback on the supervisory priorities and on the less positive aspects of the functioning of the SSM, but understood me right, in a very constructive way. So as a general comment, I would like to stress the importance of striking the right balance between harmonization and proportionality in banking supervision. I believe it would be important to recall that supervisory expectations and requirements should always be proportionate to the size, significance, and riskiness of the supervised institutions. We have to emphasize the role of proportionality in guiding the way we supervise banks in different sizes and banks with different risks, as opposed to taking a one-size-fits-all approach. This said, the first issue is presented by the interaction of the SSM with the national competent authorities, the NCAs. Since the structure of the SSM has been streamlined in recent years, most of the power has been shifted from the so-called joint supervisory teams, the JSTs, to the horizontal function within the ECB. This makes it so that the work of these GSTs become something of a box-ticking exercise, which doesn't allow them to properly take into account bank specificities. Access to the ECB horizontal function is also currently quite restricted for banks with regard to specific background information, which sometimes is not available to the JSTs. In this respect, we would recommend that the ECB horizontal function limits its activity to making sure the supervisory criteria used by JSTs are more uniform across member states. A second key issue I would like to mention is the lack of transparency that characterizes the ECB decision-making process. In fact, it is not clear to the institutions how the SREP score is connected to the bank's risk profile. Not always clear. Sometimes the SREP score is better when the risk profile deteriorates, while other times it might be the contrary. The SREP criteria are quite subjective, and there's not much understanding about how the GST calculates the risk score of a bank. In this respect, we believe that more transparency in the SREP methodology would be needed, as well as greater homogenization and adequate application of the principle of proportionality, ensuring the level playing field between institutions. Likewise, a more direct correlation between the SREP score and the proposed Pillar 2 requirements would be desirable. Moving now to the SSM supervisory priorities for 23 to 25. It is probably worth highlighting the attention that the ECB is giving to the climate transition and to the digital transformation, two aspects that will be increasingly shape the banking landscape for years to come. Banks fully understand the scale, and they also understand the magnitude of the most urgent challenge of our times and aim to avoid the most disruptive effects on our ecosystem and societies. And in this regard, the financial sector is continuing to progress in the identification, disclosure, and management of these risks, and bank efforts to sustain the economic transition keep on increasing. At the same time, banks are quickly reacting to new technological developments that are exerting competitive pressure on them by undertaking massive investments to enhance their digital infrastructures. As we will cover these topics more in detail in the course of today's event, I won't take any additional time. Mr. Smole, and thank you once again. I look forward to discussing with the other panelists.
Thank you very much, Peter, for sharing your thoughts and your thorough analysis. At this stage now, I would like to hand over to Christos. We'd be very happy to hear his views on and perspective on this topic. Many thanks, Christos.
Thanks to you, Nejc, for having invited me in this event. I have been carefully listening and viewing the presentation. Let me start with one observation on the point raised just before regarding proportionality, which is a very merited one. We need to take into account that with respect to the application of the principle of proportionality, the supervisory authorities in the SSM, including the ECB and the national competent authorities, are to a very large extent bound by the degrees of freedom they have according to the legislation. So this concern is mainly for the co-legislators to kind of introduce in an upcoming, one of the many amendments of the CRD 4 in particular, the rules concerning the flexibility that can be embedded in order for the ECB then and the national competent authorities to have more rooms of maneuver in applying the proportionality principle. Yeah, in principle, your remark is very well merited, but again, I believe that it's mainly for the legislation to be adapted rather than the supervisory authorities to apply the existing rule, which is binding on them. Now, a very few remarks. The presentation is on the SSM supervisory priorities for this and the coming 2 years. But I think that another priority for the SSM, not a supervisory one, will be to celebrate next year its 10 years in life. And that means that the SSM is in a mature stage, yeah, and has already performed on its supervisory responsibilities. The ECB and the national competent authorities, which are comprised in the SSM, in a rather efficient way. And this has been proved also inter alia, yeah, it's not the only one, by the fact that during these 10 years, we didn't have also so many, as in previous periods, bank failures. I mean, resort to the resolution framework has been very limited. And to a certain extent, yeah, mutatis mutandis, this is also due to the fact that to a certain extent, the level of supervision may have improved. One aspect which I do not see, not in your presentation, in your excellent presentation, Thomas, but in the paper that was circulated by the ECB, by the SSM, unless I have not carefully seen it, is the fact that by 2025, the ECB and the national competent authorities in the SSM will have to apply a new framework, meaning that we are waiting for the finalization of the second banking package, which will modify several aspects of the SRD4 and the CRD4 and the CRR. And this is very significant, especially when it comes to priority number 3, relating to climate change, because a lot of more powers will be given to the supervisory authorities with regard to tackling environmental and climate-related risks. Yeah, and also another novum will be the treatment of the branches of third country banks, which is another aspect which is of importance. But again, the 3 priorities, mine eventually being a 4th or a 5th, yeah, are very well described here in this paper and in the brief presentation that you made of that. Coming to priority number 1, I understand you are speaking about credit risk and funding risk. In this current environment, that would also include market risks as well as interest rate, income risk, due to the volatility in markets. And this brings me to an observation that I would like to make, which is general, but is also reflected in this paper that was distributed by the SSM, that it is one of these special conditions that the supervisory role of the ECB, the macroprudential oversight role of the ECB within the ESRB, and its monetary role within the euro system are so closely interlinked. Yeah, when speaking about funding risk, the reference, you made it also, Thomas, yeah, is made to the fact that monetary policy is changing. The ECB is gradually moving towards a new normal, yeah, with the leveraging, with abstaining gradually from its resort to unconventional monetary policy measures, gradually but steadily. We have already witnessed that. So this is one of the aspects of funding risk. On the other hand, the first elements concerning credit risk and in general, the exposure to vulnerable sectors is linked to the macro financial risks which are apparent in our environment. And this is my warning here. We have seen, as recently as in September 2022, one of the most important, in my view, documents circulated by the European Systemic Risk Board, its warnings concerning financial stability. And I understand that several risks were identified there. Yeah, some of them are classified as very significant. Yeah, and others quite significant. So in that respect, macro financial vulnerabilities are there, and apparently they are affecting also the supervisory priorities of the SSM, of the ECB within the SSM, or the SSM overall. A final remark, and I will close it here, has to do with the way that national competent authorities should be better embedded into the system. I have no specific information to the contrary, but eventually one aspect that needs to be addressed is whether the level of scrutiny that has been shown by the ECB when supervising significant banks is also being applied by the national competent authorities within the SSM when supervising less significant credit institutions. I have some examples that I could develop on, but again, this is for eventually the Q&A session. Thank you very much again for this opportunity to intervene, and I give it back to you, Nejc. Thanks.
Yeah, dear Christos, many thanks for your observations. These are, as always, very much appreciated. I guess this brings us to the end of the first part of our webinar, and now we would like to move on to the Q&A session. Here, I would like to pose a question to all panelists, and maybe we start with Thomas again, and we follow the order of presentations. Namely, the SSM's #1 supervisory priority is promoting resilience to immediate macro-financial and geopolitical shocks. Christos, you already alluded to this a little bit with your last thoughts there. And as financial industry attempts to navigate current challenges, such as the Russian aggression against Ukraine, soaring energy prices, and deglobalization, what would you say are the most fundamental aspects banks should consider when building resilience for the further challenges to come? And Thomas, perhaps you could share your views, and then we could go on. Thank you.
No problem, Nejc. But please allow me to first say a few words also on what the speakers, the co-discussants, have mentioned in their opening remarks. I think proportionality is a key point, and also we are trying to take this into consideration when it comes to our supervisory program. So I think regulation is the key part, as Christos has mentioned, in order to deal with proportionality. But certainly this does not include that the supervisor is also applying a proportionality principle when it comes to its supervisory program. I think we also do, in the sense that we also try to risk-base our supervisory approach when it comes to the intrusiveness of our supervision. So it means banks are categorized according to scores, and in simple terms, the more risky a bank is, the higher the supervisory intrusiveness in terms of on-site visits, in terms of meetings we have with the bank, and the less risky, the more secure a bank is, in simple terms, the less they will see of us. Yeah, this is something where we also try to include a principle, a risk-based approach, but also in the end, as a consequence, a proportional approach in terms of our supervision. Just one short remark also in terms of these priorities. There surely are a lot of other topics that need to be covered by supervisors, but these priorities does not mean we are not looking into any other topics. No, by no means. I mean, the idea is that we set these priorities as core principles outstanding, but every team, every JST is having its own supervisory planning process, which is also communicated to the banks, which is to the extent applicable, aligned, of course, with our overall priorities. But in this regard, they have a normal yearly program, supervisory program they're executing with the bank. That means if topics have not been mentioned in this presentation as a priority of the ECB, one topic would be, for example, interest rate. Banks, that JSTs are surely looking into this when it comes to interest rate risk or credit spread risk for the banks most affected by this. So let me now move on to your question, Nejc, and what banks should do. I mean, for me, this is clearly a topic of credit risk. Now, I mean, it was already an issue when we started with the Corona crisis. Now, in relation to different, let's say, business segments which were affected by this, now to move on to the area, to the businesses which are affected by the war in Ukraine and the second round effects in this regard. Yeah, and for us, the credit risk management frameworks, they remain the key safeguard in order to build up a resilience in this topic. Yeah, and as mentioned before as well, in the past, so let's say in the aftermath to the great financial crisis, and when the SSM was built up, we shifted our focus now a bit away from the quantitative targets, because NPLs have been reduced on a continuous basis, to the effectiveness of the bank's governance and risk management frameworks. So this is, by answering this question, that's what I would like to highlight again. The supervisory work program developed in the last years aimed to tackle deficiencies in the bank's credit risk management frameworks, so that they remains suitable in our view to address the challenges stemming from the current environment. And this is now also when it comes to the geopolitical challenges, the macroeconomic environments, a very, very key point. We will continue to engage, that's why, with the banks under our supervision to ensure that such deficiencies that we have seen are remedied and gaps in compared to our expectations are addressed. We will, for example, scrutinize the bank's loan origination and monitoring practices, focus also specifically, for example, on residential real estate portfolios, and initiate also targeted reviews on the IFRS 9 provisioning framework, because the fair and timely recognition of expected losses is key in order to know what's happening within the organization. So in this sense, also the early recognition and the provisioning framework is very, very important for us. We will also look at the bank's management of their exposures to sectors most vulnerable to the current macroeconomic environment and conduct. For example, on-site inspections on exposures to energy and commodity traders. Yeah, and when it then comes to distressed debtors, that's key for us to contain the buildup of new NPLs, yeah, which otherwise have a significant impact on the recovery of the economy. So here we want to be sure that banks are well prepared, that their assessment of new risks is comprehensive, and that they intensify their efforts to conduct a look-through credit analysis on a more granular basis to gain the clearest insight into the effects on businesses and households. So that's a point where we are urging the banks. And to put it in a nutshell, I mean, there are several points which surely will have an impact. IRBB will be affected, but high interest rates will have an effect on liquidity. But when it comes to how to deal, let's say, with the most immediate impact of this development on credit risk, this is certainly what we would expect from the banks, and this is one of the priorities that we will set with the banks. Thanks, Nejc.
Thank you, Thomas. Now, dear Peter, you have already mentioned quite a few very important things within your presentation. Would you have in this part of the webinar, what would be the most fundamental aspects that the bank should consider?
Yeah, it's clear. I think the current environment is very complex, from an economic perspective, as players still have to deal, as already mentioned by Thomas, with the consequences of the pandemic crisis, while the Russia-Ukraine war, the upsurge of energy prices and inflation give rise to new issues. And in this context, the banking sector plays a key role, as the COVID-19 crisis has clearly shown, to help households and businesses facing liquidity tensions and financial difficulties. Today's banks are a part of the solution, giving their demonstrated solid capital and liquidity position, which allows them to continue serving society even in prolonged times of crisis, such as the current one. For instance, during the years of the pandemic and throughout the current war scenario, locally rooted savings and retail banks have played a crucial stabilizing function with their infrastructure, contact management, and continuous lending. They have helped and continue helping those SMEs and other companies overcoming liquidity bottlenecks and provide stability. Looking ahead, banks will continue to be part of the solution and are committed to building resilience to tackle future macro financial and geopolitical shocks. And in order to do so, banks will continue to improve some fundamental aspects. Just to mention them shortly, the risk management, clear. We have to have robust risk management practices in place. Diversification. We have to avoid concentration risk and for sure minimize the impact of external shocks. The capital adequacy, clear. We have proven to maintain adequate levels of capital to absorb potential losses during the time of stress. Cybersecurity, to mention perhaps as a fourth point, with increasing resilience on technology, banks are putting in place robust cybersecurity measures to protect against cyber threats. And last but not least, regulatory compliance. Banks are committed to adhering to regulatory requirements and maintain good relationships with regulators, provided that these requirements are applied in a proportionate way. I think there would be much more to say, but looking at time is running out, I stop here at this point.
Yes, thank you. Thank you very much for this concise list. I mean, I'm sure that, it could go on, but we all know that each one of the points you raised has several layers to it. Christos, you mentioned some of the topics which the banks should be focused on within your initial speech in order to build resilience. You mentioned market risk awareness, interest rate risk, and also, of course, the warnings that have been issued in the recent ESRB paper. Is there anything you'd like to elaborate a little bit more on any of the topics now, or you have additional considerations to build on?
I could develop very well in the next 2 hours, but I only have 3 minutes, 5.
Yes.
As we all understand, the situation is quite complex. Let me just raise some concerns. Your question was what banks should do. And here, apparently, we need to distinguish between what the banking sector in general could improve, and then whether there are some specific issues which are affecting one category of banks or banks in specific jurisdictions. Yeah. So the problems, apparently, I'm not in a supervisory authority. I have never been working in a supervisory authority, but it's apparent that you cannot take all banks in the same basket. Yeah, you have a different kind of risk exposure, if you wish. Now, if we have three risks, which in my view are important, are number one, environmental risk. Apparently, the stress test conducted by the ECB last year on this particular aspect has proven to be disastrous. Yeah, almost no bank would meet the criteria. So this is an aspect which needs to be carefully into consideration by the entire banking system. I don't think that in their priority, this has been number one. A second one is apparently the implications from the inflation crisis. And the third point that I would like to raise, and which eventually is kind of qualifier to what was mentioned just before, is that yes, of course, the banks have been part of the solution during the pandemic crisis, and now their transformation function with the increased interest rates has been normalized. Yeah, this is given. But again, you have a sign which shows that still banks are reluctant in providing as much liquidity to the real sector of the economy as one would have expected. And in my view, correct me if I'm wrong, Thomas, we have a sign which is very indicative of that. More than 50%, 50% of the total balance sheet of the Euro system consists in the liability side of deposits at the central bank. That means that a large amount, I think it's more than 4 trillion euros out of 8 trillion, which is a little bit less the balance sheet. That means that now that the interest rate on the deposit facility rate has again turned to positive territory, banks are making too much use of that. Yeah, this means that they are still very reluctant in providing liquidity to the real sector of the economy. Of course, taking into account the fact that they don't want to accumulate NPLs. This is totally understandable. And the final point as to capital requirements. Yes, overall, we have seen that in the EBA dashboard that the capital requirements, the capital ratios have increased, but a question that remains, at least in some jurisdictions, is the quality of capital. Yeah, because you have some elements like, for example, the DTA and the DTC, which in some jurisdictions makes a very significant proportion of the total capital, and this is not high quality capital. In a nutshell, I think I have answered. Nejc.
Yes, you have, Christos. Thank you very much. At this point, I would like to, there has been, Peter has touched upon an issue when he's mentioned and built his thoughts around how the bank should build resilience in the current complexity that we're seeing, namely risk management frameworks, improving them, and internal governance perspectives that have to be strengthened, in particular to develop a sustainable business model that a bank should follow. What would you, so dear Peter, if I may ask you here, do you consider any crucial, especially noteworthy points that should underline what you have mentioned earlier? And how would, how do you find the aspect of internal governance assessment currently being reflected in the supervisory efforts that we have established now? Thank you. This is yes, Peter. Sorry if I was not.
Yeah. Internal governance is a very important topic for European savings and retail banks, especially in the context of the ongoing review of the banking package. And with the legislative proposal published in October 21, the European Commission would like to harmonize the fit and proper criteria across the European Union, clarifying the role of banks and supervisors for assessing the suitability of members of the management body and the timing of such assessments. In particular, proposing that fit and proper assessment should be conducted only ex post after those persons have taken up their duties. The Commission also set minimum suitability requirements for key function holders, including the suitability assessment by the entities and the competent authorities. ESBG is strongly against this proposal because of the current nomination and selection process in many EU member states. Although ex-ante assessment is already the norm in some member states, it requires a lot of prior preparation by the credit institutions, and at times the competent authorities take far longer than is allowed to make a decision. There are some member states, such as Germany, France, Austria and Italy, where the ex-ante assessment proposed by the Commission is not possible, legally not possible, as some credit institutions have little to no influence on the recruitment process of members of the supervisory board. In some member states, those that have a two-tier corporate governance systems, any internal assessment of supervisory board members by the institutions would even contravene national laws. For these reasons, the fit and proper legislation should be left, from our point of view, as it is found in the CRD text. I think I could add much more. Looking at the time, 8 minutes left.
Thank you.
I stop here. Yeah.
Thank you very much, dear Peter. I think one aspect that deserves a little bit more focus here, and that we have all discussed now, is the climate change. And here, perhaps, Thomas, may I ask this question? The ECB has been doing quite a lot to address the issue of climate change in the last few years, especially in the last 2 years. Now, how important is this issue for banks regarding the risk management? And let me here build also, I would like to include a question from the audience here, namely from Andreas Rolka, who says, who's asking, what can banks do to reduce their climate risks and lend more to invest in more sustainable economy? Are risk outsourcing instruments such as securitization an option? I would really appreciate it, Thomas, if you could consider also the question from the audience. But how are banks really addressing, in your view, the risk of climate change within the risk management frameworks?
So, well, it's obviously a very, very new topic for banks, to be quite frank, and not only for the banks, but also for us as supervisors. So climate risk has not been, has been a topic discussed, but in the supervisory sphere, but also in the banking sector, I think 10 years ago, that was not really an issue. That means when we started our work in this regard 2-3 years ago, it was also for us very important to get up to speed on the developments, to make the necessary effort and also challenge the banks to put this topic on the agenda. I think that was the main topic and the main ambition we had when we issued our guidelines in 2020. There were guidelines on climate and environmental risks to set expectations how banks should integrate climate change into their business strategy, into their governance and risk management. And this is basically was the starting point for us. And then we had some self-assessments performed by the banks, how they perform against these expectations, against these guidelines, then followed by a climate stress test and thematic review on climate and environmental risks in 2020. So they have these basically allowed us to get a fuller picture on how banks perform relative to the ECB expectations. And on this basis, we will now continue our work. But it's extremely important, but it's not only a question what, let's say, supervisors can do. It's very often also a decision by the banks to say, well, we would like to have a balance sheet which is having exposure to climate-friendly industries only by that and that time. I mean, this is what banks are doing more and more these days, but it's nothing that we as supervisors can impose on the banks. That's beyond our responsibility. For us, it's the main point is here to challenge the banks to see climate risk as another risk they have to deal with when it comes to granting loans, for example. Yeah, I mean, they usually already, I mean, banks have to assess the business model of a client they want to grant a loan to. And in this regard, we basically ask banks to include climate risks or physical risks as we see them, or transition risks. So the risk that the transition, that climate change will cause the client to transition their business model. Yeah. And this is what we challenge the banks to take into consideration as part of their approval process, to say, well, does this client actually have a future with the business model he's currently having? Because climate change will be a huge challenge for this person, for this client. Yeah. In particular businesses, of course. Yeah. So this is our approach, but banks have a lot of possibilities on their own beyond, let's say, the expectations that we are setting, to put this on their agenda and make their own decisions if and when they would like to have, let's say, a clean green balance sheet. Yeah, but this is something which is not imposed by the supervisor. This is something, if so, would be imposed by a regulator, by the legislator. But the banks, obviously, they have their own possibilities, and I see very often now that banks are moving in this direction. So maybe I leave it with these words and then hand back to you, Nejc.
Okay, thank you, Thomas. Now here I would invite also, for the last remarks, looking at the time, last remarks also from dear Peter and dear Christos on this topic. How do you see banks acknowledging the fact that there is this exposure to climate risks, and what kind of measures do you see them take, or what are the main first initial steps that they're doing to reduce the exposure? Peter, perhaps we could start with you.
Yeah.
Very brief final remarks. Yeah, thank you.
It's 2 minutes. So short, just one channel comment. Looking at our membership, no matter whether they come from Europe or whether they come from Bangladesh, from Malaysia, from Peru, from Zimbabwe, they all deal with exactly this question. And what we do at the moment is to organize the worldwide exchange. And it's fascinating to see that we Europeans are seen as at the forefront dealing with exactly these questions. And no matter how advanced and digitalized East Asian banks are in this context, they look at us Europeans and want to search this as exchange as our partners from Africa or Latin America. So we are working on this, and not even on a European, but on a worldwide level.
Okay, thank you, dear Peter. Dear Christos, final thoughts on?
Yeah, there are two remarks that one can make. On the one hand, I can understand that several banks are working on incorporating all these environmental related and climate related considerations into the strategy. But again, the figures that we have seen from the stress test from last year by the ECB are very disappointing. So there is something that needs to be improved to make it very, very simple. A second point that I would like to raise is that unfortunately, the Commission has not yet delivered on some of its obligations under the existing regulatory framework. I'm referring to the second delegated act that should have been adopted on the taxonomy regulation and the technical criteria with regard to the 4 environmental objectives apart from the climate related ones. So even in the legislative front, even though the initiatives are more intensive, yeah, and the regulatory framework is more intensive than other jurisdictions, there is no taxonomy regulation equivalent outside the European Union, still the implementation of the framework is lagging behind. This is just a remark.
Thank you, Christos. Now, this brings us to the end of today's session. Dear viewers, we hope you have enjoyed this installment of the EBI policy series. And once again, I would like to thank our guest speakers for a very, very thoughtful discussion on this intriguing topic. I would also like to thank my colleagues at the EBI who have worked hard to organize this event. And with these thoughts, we hope to see you next time. Thank you very much.